Hello everybody. So today in this video, I'll be discussing the case of Avago Technologies Trading Limited. It is a Mauritius jurisdiction case law. This is the first case on transfer pricing in Mauritius. Though Mauritius does not have any specific transfer pricing legislation, the tax laws have an arm's length provision requiring the transactions between related parties to reflect a commercially objective value, which is the amount charged for the services if the parties are not connected or independent. So in this particular case, there was a tax audit on the issue of the arm's length nature of the royalty payments which were made by a subsidiary to its parent entity. So let us look at the case law in more detail, all the facts and all. So Avago Technologies Trading is a part of the Avago Group, and it operates in the semiconductor industry and is a wholly owned subsidiary of Gen IP Singapore. The way the transactions were structured, ATTL acts as the principal manufacturer of Avago products, which is semiconductors, and it gets it manufactured from contract manufacturers and then sells the finished products to related parties. To manufacture the semiconductors, to get it manufactured from the contract manufacturers, it licenses the Avago IP from Gen IP Singapore, and consequently, it has to pay royalty fees to Gen IP to use that Avago IP and make it available to the contract manufacturers. Now, ATTL derives profits from its activities, which is equivalent to 7% of its operating assets, and the remainder, whatever profit is remaining, the residual amount, is paid as royalty fees to Gen IP. So usually we have seen that royalty is linked to the some factors such as sales. However, in this particular case, whatever was the residual profit is being paid as a royalty fees to Gen IP Singapore. ATTL has also prepared a transfer pricing report, and it used the transactional net margin method, which is TNMM, to justify the royalty payments. Now, the issue arose that MRA picked up, which is the Mauritius Revenue Authority, picked up this case for a tax audit, and MRA had an issue with the amount of royalty that was being paid to Gen IP. MRA said that in place of TNMM method, comparable uncontrolled price method should have been used. It said that TNMM is not appropriate for directly valuing the intangibles. Then MRA did not agree with the deduction that was claimed by Avago Technologies and allowed a royalty expense deduction of only 5% of net sales, as per the Section 18 of the Income Tax Act of Mauritius, which deals with expenditure incurred in the production of income. So the main contention of MRA was that MRA considered this royalty, which was being paid to Gen IP, as being very high. It was almost close to 96 to 98% of the profits. So MRA viewed this arrangement as a profit shifting arrangement, mainly to evade the Mauritius tax, which was 3% on the profits of ATTL. However, the royalty paid would not be subject to any tax. That was the whole argument that MRA was making. Now, after the MRA's order, there was a further appeal to the Assessment Review Committee. So the main issues in this appeal before the ARC were that the MRA contended that the cup method would have provided a more accurate reflection of what independent enterprises would have agreed upon in similar circumstances. MRA did not agree with the high royalty payments to Gen IP, which amounted to almost 96 to 97% of the profits of ATTL. MRA contended that this royalty transaction was essentially to shift the taxable profits outside of Mauritius, and this was structured to avoid taxes of 3% in Mauritius. Now, ARC heard the case, and ARC essentially agreed with the Mauritius Revenue Authority and ruled that the royalty fees paid by ATTL was excessive and constituted a tax avoidance scheme. The ARC held that the MRA's adjustments and rationale for disallowing the full deduction of royalty fees were based on a reasonable interpretation of the Income Tax Act. The ARC found that the method adopted by the MRA in limiting the royalty deduction to 5% of net sales was appropriate. The ARC also noted that ATTL's role was critical to the whole manufacturing process. And another point, which I would like to mention here was that ATTL had only 2 employees. So ARC noted that since it was getting the manufacturing done from the contract manufacturers, which were an essential part of this whole process, so the profit attribution should reflect the importance of the role of ATTL, and which is why the huge profits should have accrued to ATTL before royalty. The ARC upheld the MRA's view that the arrangement was primarily for tax avoidance, and it even upheld the 5% royalty deduction, which was made by MRA. So MRA had limited the royalty deduction to 5% of the net sales. An important observation of ARC was that the MRA had no requirement to consider the OECD TP guidelines to decide the royalty amount that would be allowed under Section 18 of the Mauritian Income Tax Act, considering that Mauritius has not implemented the TP legislation as yet. So the ARC added that the fact that the appellant had prepared a TP report in accordance with the OECD TP guidelines does not mean that the TP report was accurate and had to be accepted as it is. ARC also emphasized that the TNMM method could only be accurate if all payments to related parties had been at arm's length and all related parties had been paid for their services to ATTL. So effectively, ARC concluded that the TNMM employed by ATTL was flawed, as it did not account for the true value of services and IP provided by Gen IP. So essentially, ARC upheld the MRA's 5% royalty deduction limit as being reasonable. Now, coming to the key takeaways from this particular case. So this case, it is one of the first case in Mauritius on transfer pricing. It highlights that a TP report or benchmarking study alone is not sufficient. A taxpayer must provide robust commercial reasoning for the prices applied in related party transactions. This ruling, it makes it very clear that merely presenting a transfer pricing report, as was the case in ATTL's case, to justify the intercompany pricing is inadequate. So these documents must be substantiated by even a strong commercial justification that accurately reflects the economic activities and risks borne by the entities involved. The case highlighted the need for detailed and comparable independent transactions to support the claimed pricing. The absence of such evidence in ATTL's case pointed to the necessity of a more thorough analysis and justification for the royalties paid to Gen IP. An important point to note here is also that we do not yet know if the appellant will further appeal to the Supreme Court, and we will have to keep an eye to see how the matter unfolds if it goes to a higher level. The present case, it marks a significant and long-awaited ruling in Mauritius. It brings transfer pricing concepts to the forefront in a jurisdiction which currently lacks specific transfer pricing legislation. So this ruling, it had significant implications for multinational enterprises operating in Mauritius, highlighting the importance of adhering to the arm's length principle and ensuring that intercompany transactions, they reflect a genuine economic activity and risk, and they are as per the commercial, so they are supported by a commercial reasoning and evidence. This particular case law is especially important for all the tax professionals that deal with international tax issues either in Mauritius or across the globe. It highlights the growing importance of tax avoidance and transfer pricing in international tax structuring. It is also useful for the students of Advanced Diploma in International Tax, LLM in International Tax, or Diploma in International Tax. Do like and subscribe this video if you have liked the content, and for similar videos, see you all soon. Thank you so much for watching. Bye bye.